Are you interested in investing in stocks, but something is pulling you back from stepping into it, right? In today's video, we will show you the ultimate guide to invest in stocks. Before we get into the video, I'd like to invite you to subscribe to our channel for more upcoming informational videos, and make sure the notification bell is turned on so that you never miss a video from us. Without further ado, let's dive in. People are even more hesitant to enter this investment area with the constant, endless news of the stock market's fall. But is their fear justified? So that may be what distinguishes average investors from brilliant investors. When their stocks grow in value, most investors feel cherished. But believe us, when we say that there are investors who rejoice when their stocks fall. So, in the long run, as a result, they form the belief that they can acquire more at a lower cost. A good investor understood that the lower their price, the higher their potential returns. It is not market timing that is important, but rather market time. Keep in mind that it is time. Markets are classified into two types. The terms bull and bear are frequently used to describe market conditions. These are used to explain how the stock market is performing in general, i.e., whether it is appreciating or depreciating. Although the terms appear to be mild, their underlying causes are extremely complex. Although the direction of stock prices indicates whether a market is in a bull or bear market, there are some additional characteristics that investors should be aware of. Now, let us talk about the money you have that you can use for investment. We are referring to the money that you won't require in the coming 5 years. This concept is called asset allocation. When you want to allocate your resources, some factors play a role, such as your age, risk tolerance, and investment objectives. As an investor, it's critical to understand how much money you could lose and what circumstances might cause this to happen. If you are concerned about the investment's risks, keep in mind that there are always lower-risk alternatives. If you own a number of stocks and have a great choice for one stock market that is performing spectacularly, it will not have a significant overall effect on your financial growth. Whereas if you only have a few stocks, you are concerned that you will lose all of your money. A Robinhood portfolio is a great place to invest in financial assets like stocks. A portfolio is a window into your financial life that shows how you've decided to prioritize your money. Many people consider a portfolio to be a collection of stocks, bonds, and cash. However, it can also refer to other assets, such as foreign currencies, gold, art, real estate, or investments in private companies as well. Many factors can influence how you build your portfolio, such as how much risk you're willing to take and how long you intend to keep each asset. Robinhood is a free trading app that allows investors to trade stocks, options, ETFs, and cryptocurrency with no commissions or fees. For long-term strategies, it now offers fractional trades and recurring investments. It is best to purchase them at different price points when they are on sale. And if you refer your friends and family to Robinhood, you can get a couple of these stocks for free. Of course, there are many other platforms other than Robinhood, such as Coinbase, Webull, eToro, Binance, and many others. The essence of possible meanings of a single word, diversification, lies at the heart of the answer to the question, how many stocks should you buy? The standard definition or meaning is the act of diversifying something or the fact of becoming more diverse. You probably didn't understand how to connect this meaning to the content we're discussing. Isn't it? We'll tell you. It means that instead of investing your money in just one stock, you diversify or spread it across multiple stocks from various industries and sectors. This plan is far superior because it provides greater assurance that your money will not suddenly decline and protects you from the volatility of the stock market. For example, a volatile market is one in which the stock market rises and falls by more than 1% over a sustained period of time. The volatility of an asset is an important consideration when pricing options contracts. Consider looking for a stock that is a crowd favorite and has the potential to cross the top of Wall Street. Enron was the name of that company. Enron was performing admirably because its stock price was skyrocketing, and everyone was perplexed by the incredible growth. However, it was a huge scandal. The collapse of the fated company affected thousands of employees and shook Wall Street to its core. Enron's executives deceived regulators with phony holdings and off-the-books accounting practices. They used special-purpose vehicles or entities to conceal mountains of debt and toxic assets from investors and creditors. Given all of this, it is preferable to invest in dividend stocks because a company that pays its shareholders dividends cannot cleverly hide all of its debt. However, what if we put all of our money into a fantastic company like Johnson & Johnson? Johnson & Johnson is a household name in the healthcare industry that has provided investors with consistent and stable returns over the years. It is a dividend payer that has received dividends for 57 consecutive years without fail. Johnson & Johnson provides a variety of programs to meet employees' various needs and interests and makes these programs convenient, which is one of the most important factors driving engagement, even more than financial incentives. What if we put everything we have into it? Because it has got everything that a good investment provides. But what if we discover tomorrow that their products cause cancer and everything so beautifully visualized becomes a nightmare? The company goes out of business. That is the inherent risk of investing in a single company, regardless of its exceptional results and so on. As a result, it is prudent to invest in multiple healthcare companies. If you ask the finance community how many stocks you should own to be fully diversified, the most common answer is 20 to 30. How credible is this statement? The Journal of Business published a paper in 1970 demonstrating that you could get the maximum benefit of diversification by owning only 32 stocks on the New York Stock Exchange. To be fully diversified, you must own stocks from various industries such as energy, technology, real estate, utilities, and many others. To be considered fully diversified, you would need to own anywhere from 2 to 5 stocks in each industry, and there are many. You must sell the stocks in order to realize your potential, or you will not fully understand the mainstream investments. This is the polar opposite of the dividend strategy, in which you receive regular income on a regular basis. Apart from a portfolio that manages your account and investment details, it's critical to have other investment tools that monitor and check the security of investments, as well as one that compares one's performance to the overall stock market and provides you with concise and accurate data to deal with. Diversification is protection against ignorance, Warren Buffett said. If you know what you're doing, it makes little sense. Warren Buffett's golden rule is to invest only in businesses that one understands. Buffett has always invested in industries in which he believes. When the economy is uncertain, stick to what you know. When researching businesses to invest in, one should always be rational and do their homework. Buy a stock the same way you would a house. Understand and like it to the point where you'd be happy to own it in the absence of a market, he said. Market predictions, according to Warren Buffett, can distract investors from making good stock purchases. I never have an opinion about the market because it would be useless and would interfere with the good opinions we have, he says. A beginner should own more stocks, according to the general rule of thumb. In fact, it is preferable to invest in an exchange-traded fund that tracks the overall market, such as VOO or VTI. An exchange-traded fund, ET, is a type of security that consists of a collection of securities, such as stocks, that typically track an underlying index, though they can invest in any number of industry sectors or employ a variety of strategies. ETF are similar to mutual funds in many ways. However, they are traded on exchanges, and ETF shares trade throughout the day just like a regular stock. You will outperform the majority of professional stock pickers if you own an ETF that tracks the broad S&P 500 stock market. All the advice we give you about investing in stocks doesn't do you much good if you don't have any method to purchase stocks. The stock market isn't like a grocery store. While stock investments can help you generate capital, it requires time and effort to evolve from an amateur into a successful investor. Young and slow, keep in check the risks and slowly ease yourself into this world. Keep discovering to keep developing. The stock market is a vibrant place and varies continually. If you want only to keep up with the changing stock market, You have to be toe-to-toe with the market. With this, we have come to an end. The content in this video is for educational purposes only and hence should not be considered financial advice. All the financial decisions should be made after doing your wide-spectrum research. Do let us know in the comments section below. Also, make sure that you like this video, comment down your thoughts regarding this video, and also do not forget to subscribe to our channel to stay updated about the latest videos. Until then.